Thanks very much, Jose, and thanks to all of you for joining us here today. It is very, very good to be back in person with so many of you. And of course, those of you who are listening online, most welcome as well. The start of this year has been quite good, as Jose mentioned. We posted a strong set of results for 2021 and in the first quarter of 2022. Of course, this is during a period of pandemic and then more recently the initiation of the war in Ukraine. So I think against that backdrop in particular, we're quite encouraged by the progress that we've made and by the strength of our organization. What I'll do very quickly this morning is first to review our performance over the last year, commenting on the first quarter as well. And then we'll go through a few of the strategic initiatives that we also set out recently in February, and then repeated again at our first quarter earnings, with a bit of a focus on both the priorities, but how things are going so far. First, 2021 performance. We returned to top-line growth in the second half of 2021. Client demand for our services was strong. We managed costs tightly. We paid the dividend of 12 cents per share, which was a one-third increase on the previous year. We completed a further buyback of $750 million of shares. We accept that the pandemic set us back in terms of the achievement of our financial objectives, most directly because of the effect of lower interest rates, but also because of the dislocations in the markets in which we operate. But the platform that we have built over 160 years and have strengthened significantly over the past several years is back on track, demonstrating strong growth with good potential. We continue to think that the strategic pillars that we set out back in 2019, which themselves were refreshed from pillars that we set out in 2016, are the right ones to generate growth, value for shareholders, and completely in line with the purpose that we set out for Standard Chartered Bank. The first quarter performance was further encouraging of the progress that we're making, with good results, both in terms of income, ongoing active cost management, very strong capital discipline, and very much giving us confidence that we remain on track to deliver in excess of a 10% return on tangible equity by 2024, if not earlier. Now, quickly commenting on the summary of these results, but also how we are going to put them into action. So the 2021 summary, underlying operating profit of $3.9 billion. That's an increase of 61% year on year at constant currency. That generated a return on tangible equity of 6%, which was double that of the prior year and very close to the 2019 year pre-pandemic. We remain very well capitalized with a 14.1% CET1 ratio at year end. And that strong capital position was maintained in the first quarter, posting a 13.9% CET1 ratio. That after considering fully the impact of the share buyback, the incremental share buyback that we announced, regulatory changes, and underlying business growth. Much of this was accomplished because of our focus on capital discipline, something that I think has characterized our bank for years, but to which we paid particular attention in the first quarter of 2022, exceeding the early commitments that we made to you, our shareholders, for improvement in our return on risk-weighted assets, in particular in our corporate bank. We've indicated that we will operate dynamically within our target capital range of 13 to 14% for CET1. We have continued to do that, and we're happy to refresh that guidance when we addressed our shareholders just a couple of weeks ago with first quarter earnings. The credit quality of our loan portfolio has continued to improve for the sixth successive quarter. The early alerts, our designation of future potential problems, are now back to pre-COVID levels, obviously very encouraging. We continue to generate substantial equity to benefit both our ongoing investments. Beyond those investments, these are funds that are available for return to shareholders, either through dividends or share buybacks. We've made very good progress on the core elements of our business strategy. our cross-border network business with our corporate clients, our focus on our affluent client population, and of course, the very substantial focus on sustainable and transition finance. We're confident that we're focusing on the right areas, and we're confident that we're on track. And we will now further sharpen our execution to get to this 10% return on tangible equity level as soon as possible, 2024, if not earlier. We started reporting our business in January of the beginning of 2021 into two customer segments, our corporate segment, or CCIB, and our consumer segment, CPBB. CCIB's income was down 1%, which was in line with the group. Profit was up 57%, benefiting from the much lower level of loan impairments. The consumer income was up 1%, with increases in wealth management and retail products offset by lower deposit income due to lower interest rates. Looking at our business through the regional lens, the Asian region has had a steady performance during this challenging time. That's despite the impact of the pandemic across all of our key markets at one point or other. Income was up 1%, operating profit was $3.1 billion. We made good progress against across Korea, Indonesia, the UAE, and India, which were markets that we had focused on for particular improvement. Collective operating profit broke the $1 billion barrier in 2021, and we expect will continue to grow. Across those countries, we've almost trebled our collective performance since we first called out those markets back in 2019. In our Africa and Middle East region, income was up 3%. This was led by a strong performance in our African markets, activated by exceptionally strong cost controls and also low loan impairments. Profits of about $900 million and a return on tangible equity that was the highest since 2015 and not far off the returns of our Asian region. In Europe and Americas, we increased our income by 4%. Operating profits were up 67%. That's a very significant increase on 2020. Commenting briefly on the first quarter, underlying profit before tax was up 5% at constant currency. That's up to a $1.5 billion level with a return on tangible equity of 11.1%, which is up about 30 basis points year over year. Income of up 9% at a total of $4.3 billion. Just comment quickly on the updated guidance that we offered on our strategy. We have committed to continue to evolve and change the way that we manage our capital, our expenses, and the way that we manage our organization. We made very good progress so far, but we know that we have room to fundamentally improve in order to hit our financial targets. We have 5 action areas that we identified with a fair amount of detail in our full year earnings announcement. First is driving improved returns in our corporate or CCIB business, targeting a 160 basis point improvement in income return on risk-weighted assets. We will do that by obviously growing our income line, but also by actively managing the capital that we deploy to our clients. Second is to transform the profitability of our consumer or CPBB business, reducing the cost-income ratio to about 60% from 76% today. Accelerated digitization and productivity action will be at the heart of that strategic undertaking. Third is for us to continue to seize the opportunities in China. China has been a strong growing market for us with much improved financial performance. We feel we've never been better positioned in China and that the opportunities, current challenges notwithstanding, have never been greater. So we are increasing our investment into both the onshore and offshore markets in China, leveraging our very strong position in Hong Kong as well, and aiming to double profit contribution to the group over the next 3 years. I'll talk about the actions 4 and actions 5 in just a moment in the context of the financial framework, but briefly, we do intend to improve efficiency and operational leverage in our business with gross cost savings of $1.3 billion over the next 3 years. The result of all of this will be to deliver substantial shareholder returns, managing our capital actively within the target range that I have set out. We continue to look at every one of our business lines, our client segments, our countries and regions with a view to optimization. And on the back of each of those reviews, we'll take actions as appropriate, be those strategic actions or more tactical. We have an overarching objective to simplify the management of the group. You will have seen that we announced recently that we will be exiting the onshore business in 7 markets in the AME region, and that in a further 2, we will focus on the corporate or CCI business exclusively. We will continue to serve all of those countries from an offshore perspective, so bringing international capital into those markets at every opportunity and as requested. We think that collectively, these strategic actions have had and will continue to have a profound impact on our firm and our ability to generate strong, sustainable profits. And we remain as confident as we have ever been that we are on the right track to deliver those returns, made it certainly a little bit easier if we get interest rates going back to the pre-COVID levels, which the market is suggesting is very much on track. Now, commenting on the financial framework for just a moment, and a little bit on the component parts. We've targeted a income compound annual growth rate of between 8 and 10% between now and 2024, breaking into 4 blocks. First is a 3% growth in underlying client activity. This will be largely driven by the economic growth in the markets that we serve. Our China-related business growth, extraordinary as we expect it to be, will add another 2 percentage points to our growth. Our ventures businesses, both what we conduct in what we call SC Ventures, but also the ventures that we've included in other parts of the bank, like our digital banks in Hong Kong and Singapore, will add a further 1% to our growth rate. And then the final 3% will come from the expected increase in interest rates, recognizing that that one is entirely beyond our control. But as we sit here today, the market is quite clearly looking for a return to pre-COVID levels of interest, which would add this 3% growth rate to our overall turnout. Our operational leverage is substantial, and we're targeting positive jaws, so a faster rate of growth in income than in expenses of 2% through this upcoming cycle. And that's before considering the impact of rising interest rates. Obviously, if interest rates rise, as the market is expecting, we can expect further improvement there. That will lead us to a cost-income ratio of about 60% by 2024. And this entire package, we think, will likely generate additional restructuring costs of about $500 million beyond what we have taken so far. Now, as Jose managed, we have returned $2.6 billion of capital to shareholders in the last 3 years. We will continue to operate dynamically within our range, and should the plans turn out as we've indicated we think they will, and where we have confidence, we could return in excess of an additional $5 billion to shareholders in the coming years. So altogether, a solid core to our business. We have a set of targeted management actions and commitments, which are very clear and definitive, on which we're acting already. There is further upside from interest rates. I certainly have never been more confident that we can deliver the returns that we have committed to you. And I can tell you that on the part of the board and our management team, we are singularly focused on doing that, always in line with the core purpose of the bank. Now, if I could speak a little bit more and add to some of Jose's comments on the announcements that we've made around our net zero pathways, our sustainability objectives. We all believe that we have a unique opportunity to rapidly accelerate our net zero transition, but also the net zero transition of our clients. We do this in line with the Paris Agreement, and we can do this while enabling and supporting sustainable economic growth in the markets in which we operate. We fully expect to keep updating our approach in line with the evolving best practice and science evidence. I think we've been a complete open book in this regards, both in terms of market-leading disclosures through the Task Force for Climate-Related Financial Disclosures, and also through our net zero transition pathway, which we published back in October and have recently updated. We're transparent because we think that we can solve this problem collectively. We value the opinions of others who think we can do things better, or who have new ways or new ideas on how we can execute our mission more effectively. And as Jose said, we think we can do this in line with supporting the economic development in the markets in which we operate, and thereby affecting a just transition. We have engaged actively with shareholders, with NGOs and other stakeholders, and we will continue to do so as we continue to roll out and refine our plan. And we continue to believe, and we're confident, that we can deliver our contribution to a science-based outcome of net zero by 2050. Now, towards the end of 22, we will ask the Science Based Target Initiative to validate our targets. This is work that's ongoing in SBTI. It's ongoing within Standard Chartered Bank. You'll appreciate that the data that's available in many of the markets in which we operate is either incomplete or in some cases non-existent. So we've made various approximations along the way. We will continue to refine those as the data comes in, and we'll be looking for continuous external validation of the approach that we've taken. The flip side to reducing our own carbon emission footprint, which is, as you know, overwhelmingly coming as a result of our financing activity with clients, we have invested heavily in our sustainable finance and transition finance capabilities in order to help our clients to effect their own transitions. So we had a 66% growth in sustainable finance assets up to February 22 versus February of 2021. We had a 92% growth in sustainable finance income between February 2021 and February 22. Underpinning these transactions, we've supported clients on many market firsts, including market first sustainable linked loans, as well as deposits, continued support for infrastructure and clean technology. And we've appointed a new Chief Sustainability Officer, Marissa Drew, who will be joining us in July to help us further turbocharge that effort. So in summary, we are actively supporting our clients, our customers, and our communities through these challenging and difficult and volatile times. We're encouraged by the early progress that we've made against the 5 strategic areas of focus, which themselves have been extensions of our areas of focus for the past several years. And we are confident that we can deliver the financial and strategic objectives that we've set out. Thank you very much again for joining us and for your support. And I will now hand back to Jose.